We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is returning guest Luke Gromen, founder and president of FFTT, or Forest for the Trees Limited. How are you today, Luke?
I'm doing great, Tom. How about yourself?
Excellent. It's always great to have you back. I always look forward to our conversations. And of course, the last time we had you on, it was a very important conversation and very timely, as we spoke a lot about the beginning of the conflict in Russia. And so we're quite a ways down the road here. So I'd like to maybe start today by getting maybe a bit of a review of some of the signposts that you've seen since the last time we spoke in March that really stand out to you.
Yeah, I think it has dragged on. Let's go back in time to March. It was overwhelming consensus was that Russia really didn't have any cards and the West had a lot of cards. And my view was simply that Russia had a lot more cards than the West was letting on. And I think really key to that view was that the West was underestimating. They were miscalculating Russia's GDP from a first principles basis. And what I mean by that is they're still saying, I saw something on Twitter last week, but back then they were noting Russia's GDP is whatever the size it is, however many trillions or however many hundreds of billions. It's the size of Indiana or Ohio or, fill in the blank, much smaller country by landmass. And my point was simply, that's the price of Russia's GDP, right? That's Russia produces 10 million barrels a day of oil, we'll say, some amounts of gas, other commodities. But to simplify, 10 million barrels of oil a day times $90 a barrel, and there's, times 365 days, and there's Russia's GDP. And that's what people thought, okay, well, we can cut Russia out of the global system and punish them, and they'll collapse, and we'll move on. And the reality that and the misapprehension that Western policymakers were operating under was that. And that's the price of Russia's GDP. And everybody knows that. The problem is Western policymakers didn't consider the value of Russia's GDP. The value of Russia's GDP can be ascertained by looking at the value of a barrel of oil. It's been estimated that a barrel of oil contains 25,000 man hours of work. So let's say a man hour of work is $20 an hour. So 25,000 times $20, the value of a barrel of oil is $500,000 times 10 million barrels a day times 365 days. And suddenly you get a very different picture of the importance of Russia to the global economy. Mm-hmm. And my point was simply, at its core, was around that of, look, you cut them out. It's going to be really, you don't know what you're doing. It's a bad idea. They did it. And we get what we've gotten, which is Europe is having an energy crisis. The UK is having an energy crisis. It has factored into both countries' sovereign debt markets. It's factored into inflation rates. It has spilled over to the United States. We have mitigated it somewhat by record SPR releases, but now we're starting to run those down. You're starting to see other weird signs that we've never seen in my lifetime in the United States. Spot diesel shortages in the United States. Potential natural gas shortages in the northeastern United States. So you can see, I always simplify it, and I forget who relayed this parable to me a long time ago, but if you want to understand the value of oil, fill up your car, run it till it's empty, and then push it back to where you started from. And everybody was just figuring, oh, well, we'll just, no one was thinking about the push the car back to where it started from aspect in terms of Western policy. And so here we are. It is still dragging. The conflict itself on the ground is still dragging on. I don't have a strong view or opinion on that. I'm against war and violence, all else equal, but I don't have anything value added to say on sort of what line on what map is where it is. I don't know. Mm-hmm. What I do feel like I have a good sense around is the economic impact of what Russia would do was wildly underestimated, or what would happen has been widely underestimated. The the transmission mechanism being global sovereign, and in particular Western sovereign debt markets, I think has been dead on. We've had the worst year in the Treasury market since 1789 in the United States.
That's quite a stat.
It's quite a stat, exactly. And we talked at the time, you and I, about steps the Russians could possibly take to defend their currency, and one of those included pricing energy in rubles, or possibly even settling in gold, or whatever the case was. And interestingly enough, a month later, not even, Putin came out and said, "Yeah, fine, you're going to cut me off. Unfriendlies have to buy in rubles." And basically what he did, as we talked about on the show back in March, is he supported the currency with energy. He basically backed the ruble with energy, which is exactly what I would have done. If you're talking about economic warfare and the weaponization that we were trying to do against the ruble, I mean, how did he know we were going to do that? Simple. We'd done it over and over. I mean, it's like watching a team run the same football play over and over and over. And sooner or later, you move a couple extra defensive guys there. And so ultimately, what we thought would be a balance sheet contest between Russia and the West has turned into a balance sheet contest. When we look at how Russia has responded with basically backing its currency with energy, it did that. The ruble has been very strong. It's, I think, one of the only two winners against the dollar this year. It's not a perfectly clean read because there's capital controls, etc. But that brings us to today, where Russia's oil production was supposed to collapse. It hasn't. We're now coming up again on, December 5th. We're talking about capping Russian energy prices again, the G7. So we're a month out from that. Let's see how that goes. I don't hold out a lot of hope that it'll be that successful. But that's, I think, a decent summary. Is now we're still in this section of the balance sheet contest. The SPR for the U.S. has been run down tremendously. We're seeing spot shortages of distillates in the United States, which I've never seen before. We've got inflation that is persistent and well above sovereign debt rates in the West, causing economic problems. Russia has had its economy fall, and not as much as people would have thought. They have run massive current account surpluses year to date, in part by virtue of the capital controls. They are having shortages. Their inflation rate is, 14, 13%. Realistically, it's probably not that much higher than what we're seeing here in the West. So, I would say it's still to be determined at this point. But relative to what was supposed to happen, what consensus said was going to happen in March, it's gone way better for Russia than consensus thought it would. If you'd asked most of consensus, hey, what's this going to look like 8 months from now?
Mm-hmm. Yeah, it's really interesting to kind of be able to go back and look at, as you say, what consensus was, and then how these things played out. As you say, it was really a playbook from the US on how they ended up reacting. But I think one of the things that I'd like to touch on, and that I think you do very well, is really explaining how the Treasury and energy markets are linked, and why that's so important. So could you help our listeners understand why that's such an important piece to understand?
Sure. And this is something I think that was not well understood by Western policymakers, was the feedback loop between energy, inflation, and debt markets, the sovereign debt markets. And so energy is a master resource. Energy goes into the cost of everything. And so when you talk about raising the price of energy significantly, or curtailing supplies, it feeds back into a loop where you have this problem where the West has high levels of sovereign debt, very high levels, record, post-World War II record. The West needs growing amounts of cheap energy to grow its economy in order to just float, these high levels of sovereign debt. If you have higher prices of energy is going to act as a constraint on economic growth. It can even lead to recession. And then you're not going to, because again, normally that would not be a huge deal, except the debt levels are so high in the West. They're at unprecedentedly high levels. So you need recession is not really a policy option. You have a recession, your global output declines. Now your debt to GDP ratio is going to rise markedly. At some point, it calls debt sustainability, raises debt sustainability questions. Then you get into this weird environment where in a recession, your interest rates start to rise instead of fall, as most Western sovereigns are used to. Now, this is a classic emerging market twin deficit balance payments crisis reaction. But we haven't seen it in the West in a long, long time. And so when we have seen what Western policymakers did not appreciate was their own bargaining power, their own bargaining position, their own situation, which is to say, if Western sovereign debt was 30%, 40%, like it was in the early 1980s, broadly speaking, great. Sanction Russia, jack energy prices up, have Europe curtail usage, all these things we've seen them do, policymakers do, and we would have had a recession. And yes, there would be private sector winners and losers, but so what? You would probably have some losses in the Treasury market and other Western sovereign debt markets as a result of inflation, but so what? The problem is with debt levels this high, a recession, this inflation, it touches off debt sustainability issues that we are starting to see in the West. When you see things like the UK gilt market do what it did, nominally, was that about energy? No, it was not. However, to the extent that energy connected to inflation and deficits and weakening GDP, and that fed back, into the loop where you were getting forced pension fund selling of gilts to raise capital to cut market. It's all interrelated. No one knew where the cracks were. They never do, or where the bodies are. They just know that the leverage is there, and if you do something in the wrong direction, something will break at some point. So it's that tie between the Western sovereign debt, implied in it is a cheap and growing supply of energy that was found to be false as a result of what Russia did, and then also the Western policy response to what Russia did.
Mm-hmm. Luke, as you're talking about, let's say, Treasury yields spiking, if we combine that with a rising U.S. dollar, does that also really create an explosive situation for the U.S. domestically?
It creates an explosive situation for everybody. The stronger the dollar gets, the weaker corporate profits are going to get. The higher rates get, the weaker corporate profits are going to get. And importantly, corporate profits are going to get weaker because the rest of the world is suffering from the stronger dollar and higher rates, first or faster, right? So ultimately, it turns everything into a pain contest, into a balance sheet contest. And I think there's a bet that the U.S. Will be last. I'm not sure the U.S. will be last. I think Russia will be last if push comes to shove, if you do that, which raises some really interesting questions. It's not a question not a lot of people have asked, myself included, which is, okay, if we're gonna run a play, there's a school of thought that we're gonna run the dollar up and rates up, and we're going to break everybody else. And yes, it'll hurt us too, but it'll hurt us last and it'll hurt us least. What if it hurts us second last? What if Russia's hurt second? What if Russia's the only one left standing? What if it's Russia and China because China's willing to move away from the dollar for energy? What if it's Russia, China, and India because India is willing to do that? Now all of a sudden you've got, well, it's just Russia, China, and India. Well, it's just 40% of the world's population and the world's biggest commodity energy exporter. Oh, well, that's actually a real. So there's this simplistic view of, hey, we're just going to do what we've done in the past. We're going to break the world with the dollar. And there's been a lot of that's gone on. Obviously, smaller, less powerful emerging markets, Sri Lanka, across Southeast Asia, Northern Africa, you're already getting to very critical situations, and it's a humanitarian crisis. It's tragic. There has, again, not been a lot of ink spilled, and in my opinion, not a lot of thinking done around what happens if the U.S. is fourth last after Russia, India, and China because of these moves of being willing to price energy in their own currency. And in the case of Russia, much, much lower debt than the United States, a much better balance sheet. So at any rate, to me, the higher debt, the higher dollar, higher yields it's bad for everybody. And sort of, I think the consensus view is it's worse for everybody else first. And the United States, it's least worst for and last. And I do agree that all else equal, it's least worst, one of the least worst for the U.S. But it's unclear to me that it's last. It depends. That's dependent on the moves on the other players on the board, and everyone's evaluating as if those other players are not going to reflexively act, which is the same thing they got wrong when why the ruble didn't collapse. Why it actually is up against the dollar this year.
So as we're talking about, really China, possibly India, really using their own currencies to transact in, let's say, oil, for example, why is this a much bigger deal for those countries to be able to do, even if they take, let's say, 10% of their energy needs and be able to transact that in the yuan? Walk us through some of the math on that, if you could.
Sure. So it's really about balance of payments is critical. Balance of payments and national balance sheets have become important again. And so what I mean by that in this case is historically, when the U.S. really wants to play dollar bully, it strengthens the dollar, it raises rates, it pulls dollar capital back, the price of the dollar goes up, foreign dollar denominated debt in the Eurodollar system, you start to see these foreign dollar shortages. Once foreign nations run out of dollar reserves, not even before, but as they start to run out of dollar reserves, they face a difficult choice. They either slow their economy, so they have to raise rates to try to defend their currency against the rising dollar, or they see increased inflation, significantly increased inflation transmitted by their currency falling against dollar-denominated energy and commodity inputs, in no small part. Or they devalue their currency, which gets to the same point, to try to preserve the amount of reserves they have left. All of those are sort of bad political options for those countries, particularly if they're highly indebted. Where yuan-denominated energy, Indian rupee-denominated energy comes in, that is such a big deal, is it gives China another lever to manage their dollar outflows with. So you can go back in time, 2017, 2018, you can find Kyle Bass on CNBC and other venues talking about how oil's only priced in dollars. China has a finite amount of dollar reserves. They are growing their economy. They're growing the amount of oil they consume, and the price of oil is going up over time. And so all we have to do is keep running oil up, and they're going to run out of reserves, and then they're going to have to devalue the yuan and have a currency crisis. And it's pretty straightforward balance of payments, classic IMF balance of payments calculations. Unless China can start to manage that process by buying some of its commodity imports in yuan instead of dollars. And so, for example, 2018, China imported, there was a study by IIF, the International Investment Forum, I think it stands for, that showed that X commodity imports, China was trade surplus was around $800 billion. So what that tells you, if China bought every single ton of commodities that year in yuan, their current account surplus would have been $800 billion higher, because they would not have had to shell out the dollars to do that. The implication of that is every 10% of that commodity import budget that would have shifted to yuan from dollars would have increased their dollar input, or their dollar pile would have been left there by $80 billion, right? 800 billion times 10%. That commodity import bill for China now is probably $1.2 trillion, just based on sort of a Texas Texas hedge math, right? Where you look at where prices are, commodities, their economy is a bit bigger. Every 10% that China shifts out of dollar buying to yuan buying is $100 to $150 billion. That's incremental dollar inflows, it's enormous. By way of comparison, I think their trade surplus against the United States is 300 billion, maybe 320, 350 in a big year. So they can increase their dollar flows tremendously by switching just small portions of their commodity bill into yuan instead of dollars. And this doesn't end the potential pain for them. But again, it's not about ending pain. It's about a pain contest. And if China can drag out how long the strong dollar hurts them, that's when I say it's not clear to me that the US necessarily will be last this time. China's got a lever they have never had before, ever. No one's ever had it before except the US. So as long as Russia keeps facilitating it, as long as China keeps partaking with it or in it or having it available to use, it changes the calculus. Now, people say, well, the yuan's down, so that proves it doesn't work. No, that's not it at all. Paradoxically, the more China does this, the weaker the yuan's going to get, because you're going to have, remember, we talked before, there's all this dollar demand out there from foreign denominated debt. There's a very large installed bid for dollars. If China shifts just a small amount out of dollar buying into yuan buying, there's going to be less dollar liquidity going out through the energy trade into the world. So you're going to remove a little bit of dollar liquidity while there's still this very strong dollar bid. Less supply, constant demand is going to drive the price of the dollar up a bit. Similarly, there is no big yuan-denominated debt market offshore where there's a huge installed bid for yuan. And so if you increase the foreign supply of yuan out there by buying a little bit more in energy, you're going to see the price of the yuan fall. So the yuan dollar cross rate in response to China moving more of its energy bill into yuan will be paradoxically to fall in the short run. So it's not something they can just do all at once, because it would paradoxically crash the yuan and spike the dollar, which is exactly the opposite of what they're trying to do. So it's not a be all end all, but it's a management tool that has never been had by any other nation before, that can extend the pain contest for places like China, for India. It's not available for Sri Lanka or others. It's available for Japan if they decide they want to go with it. It's available for Europe. It's available for the UK. They're big enough. They're SDR currencies. It could happen. It would require a significant geopolitical change vis-a-vis the US, where Europe says, that's it. We're going to sign a deal with the Russians. We're now friendly. They're going to take euro, and away we go. Great. A lot of Europe's acute problems, a lot of the UK's acute problems related to these balance of payments issues and dollar issues begin to get mitigated. But it's not going to make the Americans happy.
Yeah, there's always that trade-off that's going to become really important. And I think, along that topic, is it possible that we've seen, let's say, the rest of the world take steps to reduce their risk to the US, possibly seizing their foreign reserves, as we saw happen to Russia earlier this year?
I think so. I think that has borne itself out in the data. If you look at foreign, just year to date, record central bank gold buying. There was an article on it last week. 400 tons up year over year in the third quarter, unprecedentedly strong. And what's interesting is I think 300 tons of it was sort of the mystery buyer, right? No one, they normally, these central banks declare. Whoever bought the 300 didn't declare. Now, why wouldn't they declare? To me, the Occam's razor explanation for why a central bank wouldn't declare is that they don't want someone to know. Fair enough. We know the Russians don't care. They'd probably be proud to be sticking it in our face. Chinese have been pretty open about it historically, along with some of the other players, that have been big buyers. Turkey, Venezuela at times has bought it. Okay, so we know sort of the quote unquote rogues gallery probably would have told us. So again, this is just sort of thinking out loud, intuition. But is it possible that 300 tons of buying that didn't want to be disclosed or wasn't claimed was because they didn't want the Americans to know? Is it possible it's Germany? Is it possible it's Japan? Is it possible it's Saudi? to me, those are like probably the three most likely options, quite honestly. None of those three would want to declare, hey, by the way, we haven't bought a treasury all year, but we're buying 300 tons of gold. That's a huge message coming from Japan, Germany, or Saudi. It wouldn't be out of character with what OPEC just did with the production cuts that were considered to be adversarial. So when you look to your original question of have we seen fallout? Yeah, foreign official treasury buying is down. Some of that is no question in defense of their currencies. They're trying to manage the depreciation rate of their currencies against the dollar. With that said, in a dollar shortages, central banks have bought a ton of gold, hundreds of tons of gold to be clear, and so that's quite the non sequitur, right? That hey, there's dollar shortage, the dollar's up, dollar shortage, all these currencies. Why are they buying gold, not treasuries? Why are they selling treasuries, buying gold? Sell treasuries, great. If they were just selling treasuries, you can make the case it's all defense of their currency. They're slowing the rate of decline against the dollar. Okay, yeah. But then why are they buying gold too? That doesn't make sense. So they're buying gold instead of dollars as they're selling treasuries to manage the decline rate. So to me, when you're selling treasuries to buy dollars with one hand and you're buying gold with the other hand, that starts to look a lot like a transition away from from treasuries as a primary global reserve asset, and managing again the decline rate of your currency that would occur as you do that for the reasons we talked about before.
Exactly as you kind of said in the middle there, Luke. The OPEC cut, that was something I wanted to get into. They're going to be cutting production by 1 to 2 million barrels. And I want to get your feeling on if it was to spite the West, or is it just a strategic play, just from a price and actual quota standpoint that they haven't been able to meet?
I think it's a little bit of both. I mean, I think there is an element where the economy is slowing, and so they wanted to get out in front of that. I don't know that it was slowing that much, though. I think there was very much an element of a strategic move where, if I'm Saudi, if I'm other parts of OPEC, if the West chokes out Russia using these production caps. Russia's a nuclear-armed adversarial power with no American troops in their country. If the West can choke out Russia with these caps, then it's only a matter of time until we choke out Saudi, till we choke out other members of OPEC. And so I think there was simply a realpolitik strategic awareness of what their interests are strategically. And they said as much. Their oil minister said, listen, we're not acting for Russia, we're acting for Saudi Arabia. And I think there in no small part, that's what he was alluding to, is just the reality that, okay, so you've already shown that you can just steal our FX reserves, which had to have freaked them out. And I hear credible rumblings that it did freak them out. But now, in the same year, you're talking about us helping you choke out a member of OPEC Plus, one that's got a better army than us, but nukes, all this advantages that we don't have to stop it. Yeah, we're good. We're actually gonna. So I think that's what happened. It's setting all other considerations aside. It makes perfect sense, really.
And another piece that I want to kind of pick apart, if we can, the idea that we saw so much gold demand from these central banks. It was record-setting gold demand, yet gold was down over that same time frame. So do you think that is more due to how central banks acquire their gold?
Look, if we know from how they buy bonds that if they wanted the price of the gold up, the price of gold would be up, right? Because when they want to buy bonds, they're trying to have the maximum impact, right? They want the price of the bond as high as possible, i.e., rates as low as possible, or the price of bond capped in the case of the Bank of Japan, for example. So clearly, they didn't want the price of gold up. With that said, the way the gold market also works is a little weird from the standpoint that when physical demand gets too high, it can start to create backwardation in paper markets such that you actually get spot selling in paper markets to hedge physical demand elsewhere. We saw that huge in 2013, for example, when somebody showed up in London and said, I want 1,000 tons over the next 4 months. And gold forward rates backwardated, and physical supplies. I mean, the amount of gold leaving London was so great; it was really hitting their. I think it actually pushed them into a current account surplus as a nation for a 4 or 5 month period of time. They were shipping so much gold, presumably to China. So there is precedent for when there's too much physical buying, it can lead to paper weakness due to some of it's market structure issues, some of it's just, I'm reticent to say, but I suspect too, they want to manage, if there's a lot of physical buying, they don't want the price going up, right? So the thing you never see is, and no one really knows, what's the true unallocated leverage in London, right? We know the physical gold moved. We know what happened to price. We don't know what happened to leverage. It's entirely possible that leverage went from 10x to 15x or 20x to 30x. Well, you just don't know. That would explain it too. Some of the derivative, expansion of derivatives can offset the price, right? If physical demand goes up, you can either have the price go up or you can have paper claims on underlying physical go up, and presumably physical buying was there. Retail buying was strong. We saw emptying out of ETFs as a source of supply, it appears, if you look at sort of the broad categories. Where, so you have sort of private institutions in theory and retail selling to central banks. Again, if central banks wanted the price to go up, that's an easy transaction to make happen. So it is a bit of a head scratcher. And I think it does point to sort of, when you look at gold, is like, I think gold's going to continue to sort of be a managed political metal until the day it's not. And as frustrating that is for gold investors, I think we've seen over the last 15 years, that's sort of the reality, that it is politically managed on some level.
And maybe if we can, I guess it's hard to say that we can understand this playbook. We could understand, this might be a good time to be buying gold. But as I say, to be able to, let's say, clearly understand that seems really difficult. But, you and I spoke about how gold is really the linchpin that is supporting all the debt and derivatives in the world. And you just touched on that. So, is it hard to know if this really inverted pyramid has become even more unstable since then? Because of, as you said, the unknown quantity of derivatives and leverage based on that.
Yeah, I think it's safe to say it has become less stable. You can make there have been a couple things that have happened over the course of this year where you could say maybe my interpretation of them is that there seems to be central banks getting on sides relative to winding down derivative or swaps positions ahead of a potential move higher, right? So we had the January 2022 Basel 4 or 3, I can't remember which one. At any rate, the treatment of gold that, quite frankly, was a head scratcher in and of itself. The treatment of gold is such that it's basically encouraging bullion banks to wind down their paper leverage to a certain degree. So you had that happen. You had the Bank of International Settlements. The GATA did a piece highlighting the BIS, an analysis showing the BIS had wound down their gold swaps by like 90% year to date, which again it might not mean anything. It would also be something that you would expect to see if a policy making, central bank, if we were getting to the point in this whole system where you're going to need to write up something else on central bank balance sheets. The only thing to write up is gold. If you were going to write up gold, central banks can do that anytime they want. They have printing presses. They can declare the price. They can keep the price there. But you would expect to see basically swaps, gold, things offsets unwound. The offsetting liabilities to any gold out there, you'd expect that to see that unwound ahead of such price moves. So that's not to say that it's going to happen. It might not, but it is something you'd expect to see ahead of that. So there have been some signs in addition to, this ongoing gold buying. We've seen that, again, as a non sequitur to the dollar strength that we have seen year to date.
Mm-hmm. Yeah, and it really seems that there's so many pieces of this puzzle to really try to understand and to figure out. And this volatility is just, I think, confusing for a lot of people. But I heard you say recently that the Fed might have lost control of the Treasury market. So can you explain more to us about why that might be?
Yeah, that when I said that, I was just pointing out there's an index, the MOVE index, right, which is just a volatility index of the Treasury market, and it's created by a gentleman, Harley Bassman, who's very well known, brilliant. And I was simply repeating what he wrote, which is, look, I created this index. This index is trading at 150. At 150, that implies a 9.5 basis point per day. I think it's an implied vol or it's average spread per trade, average move per trade. And his point was, given the amounts of leverage in that market, that's inhuman. Like, no human trader can manage that. And at that, his words were, at that level, the Fed's already lost control. So that's all I was saying by that. Is other prior levels of the MOVE index has seen the Fed respond.
So after Powell's press release last week, what do you see as the path forward for the Fed in the near term? And what are their biggest pieces of data dependency at this point?
I think the Fed is, to me, I thought the Fed meeting was the second most important thing last week. I thought the most important thing was what Treasury said on Monday, and not that many people noticed it, but Treasury came out and said, hey, the American federal deficit's going to double next year. Shh, don't tell anybody. And so not a lot of people are looking for that to happen, by the way. So when Treasury comes out and tells you that they're going to run a $1.3 trillion deficit over the next 6 months, which on a run rate basis is double what they did this year, then path dependency, it really throws the stress, it puts the stress right back on the Fed. Because if the Fed continues tightening with that kind of deficit, dollars going up, and Treasury yields are going up, and stuff's going to keep breaking. Mm-hmm. And it's going to happen faster because that's such a huge number, that $1.3 trillion. Mm-hmm. And realistically, that $1.3 trillion will be $1.5 trillion in a heartbeat if the Fed doesn't resume monetizing that deficit. So I've seen it framed by some people. My friend Brent Johnson highlighted it as Fed and Treasury fighting. I think that's fair. Treasury wants its free money. Fed's trying to instill discipline. And we're all just sort of trying to not get knocked over in the meantime. So I ultimately think the Fed's gonna have to they're going to have to get back to monetizing deficits. Some of it, I suppose, is probably dependent on the outcome of this election, maybe nominally. I'm personally skeptical that anything will get cut because the only things there are to cut to make a difference are too politically toxic to even attempt talking about cutting. Mm-hmm. So I think the Fed's path is really look, it's coming to a head very fast from the standpoint of what Treasury said last week, and what that implies for the amount of crowding out that will happen in global dollar markets and in global rates markets if the Fed doesn't print enough money soon. For 2+ years, really going back 5 years, we have this matrix that just shows, look, the Fed does enough, Treasury does enough. Fed prints enough, Fed doesn't print enough. And if Treasury spends enough and Fed monetizes enough, it's bad for the dollar. That's good for everything else. And the other three quadrants, are good for the dollar and bad for everything else to varying extents. And the bet was that it'd be good for the Treasury market too. It hasn't been, and it's not going to be because of the balance of payments problem issue that we highlighted earlier. So that's where it gets into this, the higher the dollar goes, higher yields, Treasury yields go, that's going to feed back into, we're going to get to a point in the not too distant future where the Fed not doing enough will be still good for the dollar, but not good, but no longer bad for gold.
Right.
You'll start to see gold go up with the dollar. You'll see gold go up with treasuries. Maybe that's starting to happen. Friday I tweeted that, Friday we saw gold up 3.5%, and the TLT, the long dated treasury ETF, down 1.5%. And I've been involved with gold markets personally since 2008. I don't ever recall seeing a day where gold outperformed treasuries by 5 percentage points in one day. That was really interesting to me. So, I don't want to play 5-minute macro with it. It could just be a one-day thing. But I've been saying for some time that once the U.S. fiscal situation gets acute enough, you're going to see gold go up with treasuries going down. And that's something that has not happened by and large for a long time. So probably since the 70s. So, let's see how that develops. But I think this Treasury update on their borrowing needs for the next 6 months on Monday last week was huge. And not a lot of people paid any attention to it. Everyone was so focused on the Fed, understandably so. But with the Fed doing 75 basis points while Treasury announced what they announced, yikes. It's very much a liquidity drain from the system.
Do you think that, something I wanted to get to from our conversation earlier, is part of that deficit for next year, does that have to do with anything with refilling the SPR at some point?
I don't know. I've not seen anything about that, but I don't know. I don't have. I've not seen anything to that effect, but I just don't know.
And at some point, obviously, that should really have a lot of downstream effects too for the price of energy and the deficit, right?
Yeah, I think I tweeted a few weeks ago, like why if the administration's coming out saying we're going to be buying energy at 75 or 80 like they did, why on God's green earth would I ever buy treasuries? Like they're telling you, people wanted like the exact math. I'm like, it's not about the exact math. It's about the signaling impact. Your government is bidding the energy market, which is bad for treasury bonds over time. And by the way, they're printing the money to do it. So like, why wouldn't I just buy energy? So to me, yeah, I mean, I think your instincts are absolutely dead on that, which is they gotta buy it back at some point. And people say, well, we have shale now. We don't need to buy it back. Shale's our SPR. And big picture sort of, yeah, but I've found when I've pressed that issue with some people, I found the people that say that generally don't appreciate the depletion rate of U.S. shale, right? The big 4 U.S. shale basins, I looked at it last month. They decline at a 5.5% per month rate. So if they need to grow production by almost 500,000 barrels a day just to stay flat. So what that tells you is that's like for in layman's terms, that's like saying, well, shales are SPR now. And yeah, sort of. It's like a bathtub being the storage for your wine if you take the drain out, right? Yeah, it'll store your wine for a bit, but you better drink it fast because it's emptying out pretty quick. So bottom line is that, yeah, they effectively have to buy back their oil short, the SPR. They got to refill the SPR at some point. And that goes from a supply of oil to a drain of supply of oil.
Yeah. And I saw a recent video of Biden saying that they're standing firm on their promise basically to not open up any more drilling. So it really, those two sides of the puzzle really don't seem to fit together at all. But Luke, once we do, let's say, see the Fed pivot, what is the downstream effect for the energy markets and the metals as well?
I would think it's really good for both. I mean, assuming that basically the Fed's not going to stand aside the whole way down. I don't think they'll do that. If they do that, it's really good for the metals markets. Maybe it's bad for energy at some point, but at some point, to my prior point, I'd rather have energy than a treasury bond that may or may not get its coupon payment if the Fed stands aside all the way down. So I think they're gonna have to pivot. I think what Treasury has said means it's probably going to have to happen sooner rather than later. And now, I thought that would happen already. To be blunt, most of the factors I thought would have had to have happened in terms of the disruptions in Western sovereign debt markets, decline off the highs in energy, et cetera, et cetera. They have not budged so far. Inflation hasn't come down as much as they'd like. I think it would be very, very good for metals markets. I think a pivot would be very, very good for energy markets, full stop.
Mm-hmm. Do you think that the markets have fully priced in all the rate hikes from this cycle so far? And what do you think are the biggest risks to the U.S. domestically from those hikes? Do those risks exist mostly in the stock market, housing, pension funds? Where do you think?
I think you're seeing them show up in housing first, which makes sense. It's interest rate sensitive. It's a leading indicator. And then I think it shows up in sort of all of the above. But I think the mistake a lot of people are making is they're waiting to see it show up in credit spreads. We saw this last week. Article in the journal, hey, look, consumers in good shape. Their balance sheets in good shape. Corporate balance sheets are in good shape. And that's true. Mm-hmm. It's true in aggregate for the consumers, right? Like, I think if you looked at the median consumer, probably less so. If you looked at the bottom 50, 60% of consumers, not at all. But on average, sure. Yeah, it's like the guy drowning in the river that is on average, a foot deep. And, the mistake I think a lot of people are making is that they're forgetting the context of how we got here, which is we had a stock bubble in 2000. It burst. We kicked it upstairs to the housing sector. Bubble, burst, kick it upstairs to sovereign debt. People say, well, all of the bond losses year to date, it's all duration. It's all because of the increase in inflation and the sell-off in the treasury market. Yes, but the treasury market's where the risk is. It's the duration risk is a function of the inflation, which is a function of central banks doing what they have to do to preserve the nominal solvency of the treasury market, the gilt market, the BO or the JGB market, European Central Bank market. That's where the risk is going to show up. It's going to show up as inflation. It's going to show up as duration-related losses. So to me, the need for the Fed with the terminal rate, they're getting into very, very touchy territory. And it goes back to the point I made earlier about gold versus a TLT being up 500 basis points in a day. You start having too many of those days, you get the terminal rate. I don't know what the number is where we hit a terminal rate where markets are going to start saying the U.S. government can't afford this, where it's going to be so obvious. I had a piece out a month or so ago, said the number's probably, at 5%, the terminal rate, U.S. governments, they can't afford that. Is it 5? Is it 6? It's probably not 7. Right. So when you have Larry Summers come out and say, hey, we're got to take it to 6 to fight inflation, good luck. Good luck. Because if you take it an inch too far, and by the way, these knuckleheads always take everything way too far, you're going to highlight that the reserve currency issuer is insolvent. Hey, 6% Fed funds. Oh, God. The way that looks is Treasury then comes out and goes, it's not $1.3 trillion over the next 6 months. It's $2 trillion. Mm-hmm. And now you're running a $4 trillion annualized deficit, and your you're within that. Your tax receipts are, your $4 trillion deficit, because your tax receipts are within that. Excuse me. It starts to become obvious to even the most casual observer that this is unsustainable. And now if you still have inflation at 5, 6, what are you going to do? Well, we can't pivot because it'll go right back to 10. Yes, it will go right back to 10. Mm-hmm. But if you take it to 6.5, every guy on the planet with a Casio calculator is going to know you can't make ends meet without like you have to slash one of those things. And you hear Larry Summers say we're getting close to a doom loop. He said that on October 21st. When you hear him saying we're going to have to put fiscal adjustments back on the table, starts to become a political issue, right? Are we going to cut defense in the middle of a proxy war with Russia? We might have to. It's not a good look. Or are we going to cut entitlements? That's, you're hearing President Biden tweeting about that today. The Republicans are going to do that. But again, great. So cut entitlements. The problem is 25 federal spending is 25% of GDP. You get to a $4 trillion deficit or annualized deficit again. You're going to be talking about 15, 16% of deficits. So you're going to need to cut 10% of GDP deficit just to get it to like the high end of where it's bottomed in prior recessions. You can't take 10% of GDP out. You take 10% of GDP out, oh my God, like the great financial crisis saw GDP fall 3.75% annualized. And that was enough to nearly collapse the system. COVID crisis, you were down 7-8%. You're going to take 10 points of GDP out immediately in entitlement cuts or in defense cuts or other. No, you're not, because when you do that, GDP is going to collapse, and you're going to have a bigger deficit. Treasury will come out the next month and go, "Ooh, it's not a $4 trillion annualized deficit; it's 5." And we're getting really close to that calculus where that's what, when you see gold up 5 points against 5% against TLT in a day, that's the real message. Is they're stuck either way. They either have to keep spending, in which case inflation takes off, or they have to slash. But if they slash, deficits are going to go up. They have the only thing left will be to print the deficit. That'll be the only choice: print the deficit or default. And okay, if you default, gold's going to do just fine. If you start seeing restructuring. And to be clear, look, George Soros had an article out last week in the FT talking about how you restructure UK sovereign debt in one of the most prestigious financial rags in the world, talking about switching the debt to what he called consols, perpetuals, something you do during wartime, right? Well, if you're switching it from a debt that has to be paid to coupon, or just coupon plus principal to just coupon, that's a default. That's a restructuring, and that's fine. It doesn't make me want to own sovereign debt.
Makes you want to own something, else, much more tangible. Yeah,
finite and tangible.
Luke, could we see the Fed raise its normal inflation target to better reflect the actual situation of rising prices going forward, do you think?
I think it's possible. And you saw Harold Malmgren, who's been in and around Washington for 60 years, say that he's hearing that it's being discussed. I think the math suggests it has to be discussed, but there's a number of people whose views I really respect who are also very well connected, saying that absolutely not, they'll never do it. So I think it's a little bit semantics. It's sort of going to happen either way. But in terms of the admission of failure, or the admission of explicitness of we're going to just devalue your savings even faster. I think you probably need a bigger crisis first before they can do that. But to the extent Harold's hearing that, that's really interesting to me.
One of the other pieces of news that I wanted to go over with you, Luke, was that we recently saw Canada order Chinese companies to divest from miners after a security view. So why is this such an important development in your view?
It's such an important development because the global system over the last 40 years has really been the Americans run deficits, we export dollars, and then you make stuff for us, send us the stuff, we send you dollars, and then you take the dollars and you recycle them into historically American financial assets, mortgages, treasuries, stocks, real estate, etc. In the last 10 years, in the aftermath of the great financial crisis, what the Chinese have been doing has been saying they can't pay us in a positive real rate. There's no chance. The paper isn't good. Ultimately, the currency is going to have to be devalued. When? We don't care. We know it's going to happen. And they're right. It's going to happen. It's math. And so what they've been doing is buying ports, Port of Piraeus in Greece. They buy They buy a bunch of mining. I mean, you buy Chinese company buys fill in the blank Canada and Google it. And it's like, I mean, obviously they've bought up a whole bunch of really nice real estate in Vancouver, and that's on an individual level. But then the companies buying up mining interests, finite materials, lithium, gold, oil, ag, all this stuff that, like we just said, finite holds its value. So that makes sense. It makes sense for China. It makes sense for the financial system. Doesn't make sense for Canada over time. It doesn't make sense for the West over time. And why I say it's such a big deal is it really is the global international equivalent of Trudeau doing what he did with the truckers' strike, which was, hey, you strike, we're gonna ding your financial record. We're going to suspend your account. All the things he did. Same kind of thing here. So it changes the rules of the game. So now what's China do? All right, well, it starts to raise questions about capital flows into Canada, number one. So that will have implications for capital flows as a result for the Canadian currency, et cetera. It also has implications for global geopolitics, because my guess is, if I'm not mistaken, that Canada is part of the Five Eyes, right? With the Americans and the New Zealanders and the UK. We at least advised on that or consulted on that decision. And if that's the case, that tells you there are preparations being made. Basically, those aren't, China bought and paid for that stuff, but they can't have that stuff. We're taking it. That's a wartime preparation, as depressing as that is. So to me, it's a really big deal on multiple fronts: capital flow, geopolitical, systemic, financial systemic. It represents a breaking of flows that, as we've seen them in last 10 years, last 40 years. So I thought it was a potentially really big deal. We'll see how it's carried out. But the response to that is China shows up and says, fine, give me my gold, give me my lithium. I'm putting it on a boat and we're leaving. So we'll see how that goes.
Yeah, it seems kind of in the same ballpark in some ways as the U.S. seizing
Absolutely
the FX reserves, right?
Yep, that's exactly right.
Excellent. Luke, I want to thank you so much for sharing your time and your awesome opinions with us. It's always great to be able to go over such high level stuff with you, and it always really puts my brain to the test to try and keep up with you. But I always appreciate it. Of course, you're available on Twitter at Luke Gromen and FFTT-LLC.com. Anywhere else you'd like to point to?
No, those are the places. You can check us out there if you're interested in learning more.
Excellent. Thanks so much for your time today, Luke. Really appreciate it.
Absolutely. Thanks for having me on, Tom. It was great talking.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.